said, wow, the risk is still there in the market. If it's not being reflected in equities, that means it's going to be reflected somewhere else. And that's what brought us into the theme and thesis that it's the bond world that's reflecting the risk. So you have two choices. You can either just sit there and say, okay, this is happening, and once it's over, we'll say, no one saw this coming. Or you can say, I'm going to step aside, I'm going to avoid these losses. Or if you structure your portfolio properly, you're going to have a great opportunity to significantly grow your assets. Hi, I'm Keith Dicker. I'm the founder and chief investment officer of IceCap Asset Management, and I'm also the author of the IceCap Global Outlook publication. So today I'm here to share with you a conversation we're having with investors from around the world. That the common theme that we're discussing with them is the risk that no one is talking about. So the most recent change we've had to our portfolio that we increased equities back in the middle of May. So we can talk a little bit about why we did that and the background behind it. But the most important thing to understand with portfolios today is that they are a multi-asset class. So it's not just a stock and a bond world. We also have to include currencies, commodities, as well as gold and real estate. But not one asset class will operate and move on its own. Everything is linked together. And so the best thing to understand with our move to increase equities just a couple of months ago is to really, what you had to do first as an investor is to shed your bias, remove your bias that you have from your home country, as well as change your perspective on things. And once you do that, you'll be able to see and understand why a move into equities, and then more importantly, what we'll talk about as well, is a move out of the bond market and a move into US dollars. When we look at the world today, most investors, you're looking at the trees and the branches. A lot of media today, they always lead and they end with equities all the time. And the key or the trick to really understanding what is driving investment markets today is not the stock market at all. You have to look back at what's happening in the fixed income world. When we talk about changing your perspective and your bias, really the first thing to grasp is that today in the world there's a lot of confusion. And what we call it is that there's a collision between social, political, economic, and financial factors. So everything is just hitting at the same time. And it's causing investors to either trying to seek growth elsewhere, seek yield or income, or even go into other markets for growth. When we look at the world, one of the key defining points is to really understand, it's not which way the economy is growing or what level equities are at, is to understand what the direction is with interest rates. And when we talk about interest rates in our world, we don't talk about the Fed or the ECB or the Bank of England. What we really want to look at is what's happening with long-term interest rates. And what a lot of people don't understand with perspective in the world is that if you look at long-term interest rates, they were around 2, 3, 4% in the early 60s. And then they went straight up like this to about 15 to 20%, depending on which market you're in the early 80s. And during that rising rate environment, it was horrible. Such a horrible time to be invested, especially in the fixed income world. But what happened next, interest rates went from basically 15 to 20% for almost a 40-year period, so right down to zero. And when you consider that market and that movement, this is the most important part for people to understand today, is that over that 35, 38-year period, with interest rates going down, everyone made money. So not only did equities go up, but bonds went up as well. A lot of my great friends, they manage money in the bond world. And we always say the bond guys are the smartest guys in the room. It turns out it's not true at all. They just happen to be investing in a period where interest rates are going down. And the other thing to consider when interest rates are coming down is that over that period is that everyone working in the industry today, they've either started work during that period with declining long-term rates, or they were trained by somebody in the same period with long-term rates. So people that started work in the late 80s, early 90s were trained by somebody that started work in the 80s, and then the late 90s and the O's and so forth. Now even today we have people and we have traders on desk, new people coming out of universities and so forth, where their entire academic and entire professional career is spent entirely in a period with zero and negative rate, as well as money printing and quantitative easing. So that really distorts perspective. So back to the whole conversation about why would we make a change recently on equities, it really then comes down to understanding we have this period of long-term rates declining from that 15-20% level, rate down to zero, and they hit the zero range because of the 08-09 crisis. What should have happened then is that long-term rates should have started going up again. But instead, when that crisis hit, central banks around the world, they got together and they said, wow, we got ourselves into another mess here. We got to get ourselves out of this. And what they did, instead of forcing investors to take losses, they said, let's socialize this bad debt problem we have. So instead of bank investors taking losses or bondholders taking losses, they bailed out those different entities and they spread the losses across society. And they did that by having over 700 interest rate cuts. They instituted about 14 to 15 trillion in quantitative easing over the same period. We went down to a zero interest rate policy. And then as well, you had the Europeans led by the ECB, as well as Sweden, Denmark, Switzerland, and then Japan as well, went to negative interest rates. And by doing that, what they did was that they took the yield curve. Instead of having a normal yield curve, we have lower rates at the short end of the curve and sloping upward for higher rates, that they actually pushed down the long end of the yield curve. So we have a flattened yield curve, but most importantly though, and the most dangerous part where we are today, is that we have a negative yielding yield curve, specifically in Europe. So the risk today that few people are talking about is that they fail to understand that the most, manipulated or suppressed market that we have in the world today, it's not equity markets, it's not a part of the precious metals world or anything like that. It's the long end of the yield curve, specifically over in Europe. And the risk that people fail to realize is that right now the ECB is the only buyer of most sovereign debt in the ECB. So private investors have long ago, they've flown the coop, they're gone. So the true price and the true yield on sovereign debt, it's not known. The Federal Reserve is, they're bringing the treasury yield back into private investors or property investing and setting the rate. But Europe is a completely different story. Japan is a completely different story. Same with Switzerland, same with Sweden and Denmark and so forth. And what's going to happen now is that where the ECB are at the final stage of Draghi's term. His term will come to an end early next year. There's also been a change in the political influence within the Eurozone. Merkel's power and status has been weakened considerably. And now all of a sudden you're getting what a lot of people will call more extreme or moving away from center political parties, especially in Italy. That's the key one to look at. And as all this is happening, all of a sudden now we're going to start to see long-term rates spike up higher. So most recently, for example, we tell investors two main stories. One, back after the American election in 2016, the 10-year went from 1.7% to 2.4% in just a matter of a couple of days. So that's a 0.7% increase, 70 basis points, and they were over at 1.7 trillion in losses around the world. You speak with some of the big managers around the world that were managing money back then, and had a conversation with some of them, and that's on a scale of 1 to 10. What's the stress been like over the last 48 hours? And they said, oh, it's been an 8. So I tell investors, if you think about that for a moment, that a simple 0.7% increase in the 10-year in the US caused the biggest fixed income shop in the world, the ring, to go down for an A count. I mean, that's valuable to know. So in our portfolios, the important concept to understand is, first of all, that most investors today, they're not relative return investors. Individuals, private investors, they are absolute return. So they're not, if the markets are down 10% and they're down 5%, they're not happy. They want to be a positive return all the time. And what private investors are doing mostly is that you run away from trouble. So when we look at the world today, what's traditionally been viewed as a risk-free asset or a safe place to be invested is typically the bond market, and equity markets have been the risky market to be in. We anticipate that swinging around. So when we look at the bond market today, talk about significant moves that made recently for our portfolios. Yes, we're increasing equities, but we're also decreasing fixed income to minimum amounts. On the currency side, we're certainly focusing on US dollar and have minimum exposure in other currencies. So ultimately what's been happening recently is that when you think of the world and you go back to the last couple of decades in markets, there's always a key driving force. So you would argue in the 90s it was the stock picking environment. Then you had all this capital going to the tech market and so forth. And then in the beginning of the next decade, in the 2000s, early O's, it was really driven by a commodity-driven theme. And what we have now happening in the world is what I would call a dollar-driven theme. And when we talk about perspective and bias, most people are unable to have an open mind and a true global perspective of the world. For many reasons, a lot of people are negative on the US from a financial perspective. And many times from what we're hearing is that the reason it's either politically motivated, socially motivated, or even financially motivated. And they just look at the US on its own. So for that reason, there are a lot of dollar bears around the world. When we look at the key factor today that's driving markets, it's the US dollar. So the best way to think about it is that think of the world as an accordion with the US dollar in the middle. During good times, it's going to come out and money is going to leave the dollar and go out to other markets, with emerging markets being on the perimeter. And then during bad times, during periods of market fear, people want safety, money goes back inside. What's happening today is because markets have been so distorted in the bond world. It's not only is the US dollar used by Americans, for their fiscal operations and monetary policy. You have a lot of emerging market countries as well as multinational companies. They issue, they borrow, they live in dollars. And what's happening today is because money is flowing back into dollars. And it's not because the US is the best market to be in. You really have to look at it from what are they running away from. So when we look at China as an example, the Chinese are taking money out of China all the time. They're buying real estate in San Francisco, Vancouver. Russians are doing the same thing, going into Vancouver, in the Middle East, into London in the Middle East. And the question is not that, is this an attractive market to be in? You have to look at what are they running away from. And so that the beneficiary of that today is the dollar. So it's soaking up so much liquidity around the world. And then when you have money running into the dollar, it actually acts as a deterrent from other investments and other asset classes. And that's when we come back into the bond market. So when we carry that forward and look at the bond market today, again, the key one to look at is what's happening in the Eurozone. So we mentioned how in emerging market world, money is coming in the dollars and same with China, Russia, money's going to those local markets. What's happening in the Eurozone right now? Investors, private investors, they're seeking safety of their capital. It's not a return on their capital, it's a return of their capital. They want to get their money back. So you have two movements taking place. Money is going into the German bond market for safety, and then money is coming out of the Eurozone specifically. The biggest market movement that we've seen now over the last number of years that everyone should be taking notice of is that when the new Italian government was elected and the coalition, when they announced who their new finance minister was going to be, who's a Eurosceptic individual, immediately the ECB said, well, we can't have this. We're going to teach them a lesson. And what they did, they didn't buy any Italian two-year bonds that day. So the Italian two-year bond spiked up almost 200 basis points in one day. So those at the ECB, they would say, okay, we just shot one across the bow of the Italians. We're going to show them. And they said, if you don't behave and do what we want you to do, we're going to do to you what we did to the Greeks. So this is a shot. This is telling you that, hey, if you're in the bond world, you need to know and understand that long-term rates can go up instantly like that. And then the way that losses work in the bond world is that you're going to get this leverage effect with duration. When we bring that back to our portfolios, the one item that we believe most investors are missing is that they're always looking at equities first. They see equity as the risk. And we see it as the other way around. So we want to run away from the risk markets and keep our money in what we believe will be not only a return of capital, but a return on a capital. So that brings us into the equity market world. Central banks and governments will come to the rescue. So central banks would cut interest rates to stimulate the economy, and governments, they would spend more money to stimulate the economy. Of course, what would happen over time is that governments, they continue to borrow and borrow. So they were running deficits, so they're spending more money than they're collecting in taxes. And then with central banks, not only would they cut interest rates, but they're even too low for too long. And when you look back in time, what they did to help the crisis in the late 90s from long-term capital management, that actually sowed the seeds for the 2000 tech bubble. Then when they came to the rescue of the tech bubble, by keeping rates so low for so long and the government taking on new spending initiatives, that then created, that sowed the seeds, it planted the seeds then for the housing bubble that took place in 2008 and 2009. So when we bring this first full circle, we know there's always a crisis out there. It's always coming due. And again, back to our perspective on the world of what we've been trained to look at, is that we've always viewed the trouble as being ultimately reflected in the stock market. Whereas the key turning point, though, is that after the 2008-09 crisis, when governments and central banks decided to socialize the bad debt problem, is that all the crisis that wrapped up around that time around the world, they took it out of the equity world and onto the balance sheets of the governments, which is effectively the bond market. So as we expect this to play out, you're going to wake up one morning, we've already seen it happen very briefly in Italy. We've seen already the crisis that is developing in emerging markets with their fixed income and on the currency side. But the way this is going to play out is going to be two ways specifically. First of all, money is going to run for safety. So we expect it to flow into dollars. So money, foreign capital that's in Europe, Canada, Australia, Asia, and emerging markets, that is going to seek safety in dollars. That will come out of the bond market. So it will either come out of the bond market and go into equities, or equities which have a low correlation or low sensitivity to interest rates, or more importantly, they will flow into treasury markets first. So Treasury will still receive bid during this type of crisis that we expect to happen. We expect money to slide down the yield curve. So the short end of the curve will attract all the attention. And then underneath then, you're going to see a lot of stress building. So anyone that's in the funding game, they need to borrow to stay alive and continue to live the next day. That's going to be a very dangerous place to be invested. So with this type of environment coming up, investors should be incredibly optimistic and excited about it. We can't stop it. This is happening. So you have two choices. You can either just sit there and say, okay, this is happening. And once it's over, we'll say, no one saw this coming. Or you can say, I'm going to step aside. I'm going to avoid these losses. Or if you structure your portfolio properly, you're going to have a great opportunity to significantly grow your assets. But again, it comes back to changing your perspective on what's been happening over the last 35 years and where we are today. So within the equity market, it's kind of interesting because IceCap itself, back in 11 and 12, we were quite bearish on the equity world. We could see all the risk that were out there that were stemming over from the 08-09 crisis. In our mind, that the risk did not leave the system, it was still there. And we fully expected that risk would get reflected in equity markets. But what happened next was interesting. As time would roll by, more and more we would see, wow, equities are not correcting here. Despite all the fundamental reasons for equities that they should come down hard, it wasn't happening. So the hardest thing to do as an investment manager is to change your view. It's incredibly hard. A lot of managers will dig their heels in or stick their head in the sand. They're not going to change. But back then, we had to make that decision. We said, wow, the risk is still there in the market. If it's not being reflected in equities, that means it's going to be reflected somewhere else. And that's what brought us into the theme and thesis that it's the bond world that's reflecting the risk. And as the world would go on and continue, we heard the story that when QE would come to an end, that equities would correct aggressively. And in the US, that the QE, it did end. Now they're quantitative tightening, they're reducing the balance sheet. Equities are continuing to go up. Look at valuations on equity markets, valuations continue to go up. The stock market's being supported by stock buybacks. Economic growth is slowing around the world and equities continue to go higher. So one of the key metrics that we would use when we decided to add to equities back in May was that we want to look at trend and momentum factors. So it completely removes valuation from the equation. And we looked at, despite the correction that started back in late January of this year, we're now trading in a range, and we're not seeing any more red lights flashing. And because our long-term view of the crisis will manifest itself in the fixed income world, which we're seeing that occur, as well as currencies, that gave us the green light to add further to our equity position, but most importantly, to continue to add to our US dollar position at the same time. When the crisis gets going, it's gonna, again, it's not a simple two asset class world we live in. And it is our view that equities will likely experience a downturn as soon as this begins. But as it gets rolling, especially in the bond world, equity markets have liquidity. The bond world does not have any liquidity. If a bond manager needs liquidity, they need to reduce their positions and get out. There's no bond exchange. There's no counterparty. You actually have to find someone else to buy your position. Because that doesn't exist, you have a lack of liquidity in the bond market. And further still, when you look at the fixed income positions of both the average investor, private investor, most have a derivative of the balanced fund mandate. You look at pension funds, they're anywhere from 40 to 60% in fixed income with a 6, 7, 8 year duration. These guys are stuck. They're not going to be able to move. So initially, when the crisis does re-escalate, you will see the movements first in currencies. Equities could start to move down at the same time, but then you'll see the ship right itself immediately. So then money will start flowing into US equities. And when we talk about the equity world, it's very important to understand or distinguish the difference between firms that are highly sensitive to interest rates and those that are not. So in our world, we would expect the banking sector as well as insurance sector to underperform the rest of the market. Any firm that's completely reliant upon rolling over debt to survive, they're going to have a tough time as well. That's going to happen. Other firms with very clean balance sheets, they're going to attract a lot of capital coming in. And those are the ones that we want to focus on. When we look at the opportunities that are coming up across equity markets, again, equities would just be a beneficiary of all the chaotic movements that will be coming up in the bond world as well as the currency world. It's incorrect for investors to view equities first, everything else second. Put equities number 3 or 4 on your poll to look at. Again, it's going to be driven in that world, the currency world especially, which will then drain or attract capital elsewhere. The other point that investors need to understand with every crisis that comes up, this is not long drawn out. This is not a 10-year affair where people are going to be mumbling about it, for generations. These things happen extremely quickly. And before you know it, it's over, and then we move on to the next crisis. So we really view the world as being a 3-currency world. You have the US dollar as the foundation. Next up is Japanese yen, and then euro. And in our mind, all other currencies, they don't really matter in this story and in this discussion. Money will flow first out of euro, down to yen, into dollars. Once the Eurozone has their crisis and they've sorted things out, then next up on deck would be Japan and the Japanese yen. And we have a bullish view on the US dollar currently. We expect to make a lot of money in US dollar markets. However, do not confuse this as being a long-term investment, because ultimately the crisis, it will hit the US. We have to remove linear thinking from our bias and our perspective. And I mentioned earlier, beginning the conversation, that there are a lot of reasons to dislike investments in the US. That's absolutely true. That has not left the room. However, that's just going to mean delayed. It's pushed down the road, and that will come into roost as well. So volatility is going to be significant. Opportunities to make money significant, as well as lose money. So you just have to make sure you're following the logical order as it plays out. It's always interesting because as a manager, we get a lot of questions. They'll say, what do you think the Federal Reserve should do? What do you think the Bank of Canada should do? And so forth. And we always reply that what we think they should do, it's irrelevant. Instead, it's understanding what are they going to do. So once you understand how a central banker thinks, how a government entity is going to think, then things become pretty simple. You're going to see what's happening. So first of all, on the fiscal side, as soon as long-term interest rates start skyrocketing, start surging, the first thing that immediately happens is that the fiscal positions of country governments, they deteriorate very quickly. And this is especially going to happen in Europe. So right now, for example, Italy, the only reason they can borrow is because the ECB is lending to them directly. Private investors are not there. As soon as interest rates go from 1 to 2 to 4 to 8, As soon as it reaches that 4 to 8 spike, it's game over for these guys. They can't borrow anymore. So governments are going to become very aggressive on the taxation side. You're going to see taxes go up, whether it's income taxes, sales taxes, or even property taxes. But we're going to have that reaction from governments. And they're likely going to say it's not their fault, it's somebody else's fault that this has been happening. That will happen on the taxation side. Central banks, it's pretty well established that they're going to pull something out of their sleeve to try to fix the problem. They too may likely not admit that it was their response from the 08-09 crisis that caused this current crisis to start with. So again, we're going to see some incredible movements coming up. But again, the most specific one would be on the currency side. You're going to see restructuring taking place in the Eurozone. And once that takes place, it's going to cause a lot of different cards then to start following around the world. The key point that people don't realize with the bond world as opposed to the equity world is that equities can be sector specific or region specific. So you can have a crisis develop in one country in the equity world, and it will not impact anywhere else. The bond market is different. We all live, eat, and sleep and walk on a global yield curve. So a crisis in Europe, it will spread over to a crisis in Canada, down to Australia, and so forth. It is this funding market that people have to look at. And once it happens, again, we're going to see taxes go up, currencies will go down, and US dollar will go up. So as the crisis develops, the hardest hit will likely be pension funds. Most pension funds they're running a deficit currently. So most of them can be underfunded anywhere from 10 to 60%. And a lot of those funds will have 40 to 60% invested in fixed income. So a lot of these funds, they're going to experience losses. A lot of the losses will be permanent. And so for that reason, for a pension fund to make that up, they either need an enormous contribution from the plan sponsor, which in most cases would be the government side or the corporate plan sponsor, or they need to increase contributions. But it's going to be a real struggle for the pension community. But again, we're painting a very difficult moment that's coming up. But it shouldn't be viewed as something that's pessimistic. We see it as an optimistic opportunity. If you are a fiduciary in the investment world, you can step aside, move away from the trouble that's going to happen. And if you structure yourself correctly, again, the opportunities are coming up to make a lot of money for your clients. And that's the way that we see it.